Hello everyone, welcome back to the Baking Analyst channel and a very happy new year 2022. I hope everyone's had a great holiday season, they're staying safe and spent your time and gains with your friends, family and the people you love. Because that's the entire point of making these gains, right? You make all these gains compounded over time and then what? So for many of us, the start of the year is really the time to review, reevaluate and reposition ourselves for the new year ahead. And as a result, in this video, I wanted to talk a bit about how yield farming has changed my personal attitudes towards money and how it can potentially apply to your strategy going into 2022 as well. And I'll be approaching this from two perspectives, first as an investor and then from a personal finance point of view. So I hope you like what we have got in store for today. If you're completely new to the Baking Analyst channel, we cover everything from cryptocurrencies to economics and personal finance with a focus on yield farming for now. And if you're completely new to DeFi and you're wondering how on earth there are people just staking their cryptocurrencies and earning decent sums of passive incomes at ludicrously high interest rates, well, I actually have a free online course that you can get with a free trial with Skillshare in the link down below. You can sign up for a free trial, access the course, learn the material, and cancel anytime, and it will come at no cost to you whatsoever. So with that shilling out of the way, let's jump right into the content. So first of all, let me preface this with a backdrop of what's been going on the Kronos chain as of late. So rates on Kronos have pretty much been decimated. We're only seeing double-digit percentage APRs, and these are generally not very attractive anymore. There are some areas where there's still holdouts, there are triple digits, but these are nowhere near the levels we saw when Kronos first launched. However, not to worry, 140% still very good. So this is CRO. This is one of the new yield aggregators. It's been KYC'd with MCN Ventures, which is basically the team that the creators of vfat.tools works with. And then they also boost yields every full moon. So if you believe in cycles of the moon theory, you could get into this. You stake your VVS LPs or your Chrono LPs, and you earn higher APRs, dual yield APRs in both their token as well as the underlying farm token. So let's move on to the main part of today's video, shall we? Today I wanted to talk about how yield farming has changed my relationship with money for good and how it can do the same for you. And I'll be approaching this from two perspectives, one as an investor and the second as a spender or a consumer. So let's jump right into it. First of all, as an investor, we often ask ourselves as investors, do we just hodl the coins? Do we stake it somewhere, let's say the crypto.com app? Or should we just stick it on a yield farm and expose ourselves to the risk of impermanent loss, smart contract risk, and risk of rug pulls? So really, when it comes down to it, what yield farming changed for me was a shift in mindset. And it is also possible that this could be the case for some of you out there as well. Leave a comment down below. Before this, when we were only discussing, what stocks to buy, what coins to buy, we were really coming from a mindset of a price speculator. This might not be a popular opinion, but if you're just hodling your coins and you're not putting them to use to generate cash flow, you are a price speculator, because the fundamental reason for you investing in that particular coin is that you believe somehow that the price is going to go up at some point in the future. However, with yield farming, price speculation becomes secondary to what is often called the eighth wonder of the world, which is compound interest. Now, that is not to say that there is no speculation whatsoever in yield farms. If you are farming a, let's say, CRO, BTC liquidity pool token, you are price speculating as well, because you're expecting that CRO is going to go up in the future as well as Bitcoin. However, CRO's fundamentals do seem very strong, and let's say if you compare it to the legacy banking sector, crypto.com, they have cards in Europe, they have cards in the US, they have cards in Asia. There's only so few traditional banking institutions that can reach this level of penetration on a consumer level. And the first one that comes to mind is a giant like HSBC. So think about that. So I often get asked, what about impermanent loss? Wouldn't you make more money just hodling some of these other coins rather than monitoring your yield farms, repositioning your yield farms, and trying to get as much gains as possible, when at the end of the first year you might not see that much difference as compared to if you were to hodl a single coin? And this is where I want to talk about the different avenues to upside that yield farming and hodling have. So hodling has only one avenue to upside, and that is price appreciation. However, with yield farming, we rely on two avenues to upsize. So you can think of this in corporate cringe terms as a two-pronged approach, because you rely on both appreciation of the underlying assets, and you also have the element of compounding, because you're always being paid a farm token, and this farm token can be recompounded into the same LP that you're farming with, so that regardless of a bull, bear, or sideways market, you're always accumulating more of the underlying asset that you want to hold. The way I like to see it is there are three scenarios that can affect investors in any market. There's the bull market, where prices just go up. There's the bear market, where prices trend downwards, and there's a sideways market where prices just chop around a specified range. So let's see a conservative example, okay? One where HODLing CRO is likely to give higher returns in the bull market than yield farming, and that is the CRO USDC yield farming versus the strategy of just holding CRO in your wallet and waiting for prices to increase. So down here on the slide, we have bull, bear, and sideways markets scenario. So in a bull market, let's just assume for argument's sake, all right, for argument's sake, that HODLing CRO is likely to give you a better overall return. But remember, this depends on the APR of the farm. If the APR of the CRO USDC farm is high enough, that win could definitely be taken away from the HODLers. Alternatively, if you're farming with two highly correlated assets like CRO ETH or CRO BTC, you're likely to also see comparable upside if the two assets move in tandem. Next, we look at a bear market scenario. So in the bear market scenario, definitely the winner is hands down CRO USDC yield farming. The reason for this is because you have half your assets in stable coins that are constantly rebalancing to 50-50, and half your assets in the currency that is depreciating, which is CRO. Compared to if you were to just hold CRO, your losses from a capital perspective are likely to be much less. You are also going to still be earning yield in that farm token. And on a farm token, price might have gone to crap. But the thing is, you're still getting paid, and therefore this additional yield is likely to make up a bit for the depreciation in value, and this additional yield is something that you would not get if you simply held. Lastly, we move on to the sideways market, which seems to be what we are in right now, if not slightly downwards. And the winner for that would be yield farming. So we assume that prices don't change. Let's say CRO USDC prices stay constant and CRO's price stays constant. There's no capital gain to be had whatsoever. Well, the hodlers get nothing. The people who are yield farming CRO USDC still get paid in the farm token, and they're able to compound it and earn income at an accelerating rate regardless of, whether the market goes up or down or even sideways. So looking at all these three scenarios, that really compelled me to shift from a price speculation mindset to one that looks at income generation and compound interest. So if you're on a hodlers camp and you completely disagree with this, I would love to hear your comments down below. And we could go on and on with game theory and such, thinking about expected values, payoff matrices, but that is besides the point because these numbers can change. From my perspective, it just seems to be the case that in two of the three scenarios, even if I'm bullishly biased, in two of the three scenarios, yield farming wins. And that's what I'm doing. Feel free to disagree though. The next area where yield farming has completely changed my relationship with money is in the area of how I spend it, or from the perspective of a spender. The key concepts I realized through this whole journey of yield farming at triple-digit APYs is, how much time value of money matters, whether we should pay cash for everything or whether we should opt for buy now, pay later options if they're even possible, and pay in installments. So again, there is a clear shift in mindset. Before we're always told up, especially as Asian kids, you should pay everything up front, you should not owe anything, try not to pay in installments, especially if it's affordable anyway, just pay in cash. However, after looking at the whole yield farming situation and how you're earning triple-digit APYs and even double-digit APYs on stable coins that basically don't change in value, I realized that really capital is king, and that capital on hand is king, because capital on hand is capital that can work for you and produce cash flow. And if it is gone because you paid all of it up front, then you lose out on huge opportunity costs. So let's break down the idea of time value of money, because I feel like this is so important in the area of yield farming, simply because we're earning such high rates, and that this should be a consideration in our day-to-day lives, not just in the yield farming arena. And we start off with an example that is really close to a lot of us in the audience. I know that most of the people who watch this channel are between 18 and 34 years old, so college fees are definitely something that are recent memory or are dominating your finances right now. So in this illustrative example, as an international student in the UK, college costs about £21,000 a year. And we use the pound sign and dollar sign interchangeably in this argument because honestly it doesn't matter, it's just mathematics. So let's say we're given the option whether to pay it in thirds or installments or pay it in full at the start of the school year. And then we have the new opportunity of yield farming, which is what if we put a third of the fees, or 7,000, on a yield farm at 110% APR and only pay that in 9 months on a final installment. Well, the concept of time value of money is that money now is worth more than money later. And the degree to which money now is worth more than money later depends on the discount rate, or in a lot of finance textbooks, they call it the interest rate. And so because our interest rate is so high, it will stand to reason that the discount rate that we face is also very high. So earlier on, we talked about a hypothetical yield farm with an APR of 110%. And of course, this is not financial advice. We're just running the numbers here. And we see that the daily interest rate is approximately 0.3%. And we have 300 days until this 7,000 is due. And we find that if we discount it to the present value of that $7,000 that we will pay in 300 days is only worth $2,849 right now. So does it really make sense to fork out that 7,000 up front when you know that the present value of that payment 9 to 10 months down the line is going to be less than half of the present value? And this is where opportunity cost of capital comes in. So that was present value. That is essentially the amount that you need invested in the 110% APR yield farm in order to be able to just pay off that $7,000 or £7,000 at the end of the year. But what we really want to look at is the opportunity cost of capital. What else could you have done with that £7,000 that you had on hand rather than paying it straight to the school? Well, if you had put it on 110% APR yield farm for a period of 10 months and you diligently compounded it daily, your total interest earned would have exceeded the initial balance at a total of $10,000. And this would mean that your $7,000 or pounds, whatever, has covered not just the final installment, but a good chunk of the rest of the year's school fees. So this is definitely a powerful example of how compound interest works and how, with the opportunity that yield farming provides, paying upfront in cash to me just doesn't make any sense if you have the option to pay down the outstanding amount in installments at 0 or low interest rates. So I hope this has been an interesting and educational video. And of course, I'll be back with some farming updates once new projects start launching and things start running again. As you know, this week has been a week of holidays, and obviously it's been a light news week. Devs need their time off as well. So definitely look forward to looking into more farms in the new year 2022. Thanks for watching, and I'll speak to you soon.